Responsibility accounting. Responsibility accounting is a key management control tool for a decentralized organization. So the entity is decentralized, XYZ entity. Decentralized, maybe division X, division Y, division Z, like decentralized. The head of division X will be having the power to take the decision related to X operations and Y operations. Y's head will take the responsibility to control this. Z will take the responsibility for administrating this. Rather than everything was decided by the top management, probably CEO. So the work is now diverted to the three, decentralized. While decentralizing, we have to measure whether this department or this division's head is performing better or not. So then automatically responsibility accounting comes here. This head will be now responsible for the results of this particular division. Ensures that costs are incurred in accordance with the expectations of this X department head. Should ensure the cost should be incurred as per the expectation, not more than that. And making that person's spending is responsible for controllable cost. If there is any controllable cost, we will now ensure that particular person should be responsible for any deviations in that cost. That's called responsibility accounting. So it's a management control tool for the decentralized organizations where cost should be spent to the expectation. If there is any deviation, making the person responsible for is responsible. Okay. So the responsibility centers are of 4. In divisional measures, already we discussed, we have responsibility centers like cost center, profit center, revenue center, investment center. Especially cost center related to the department where it has predominantly cost. Okay, which is the smallest segment of activity or area of responsibility which costs are accumulated. Maybe fixed and variable cost. Here, cost of capital will not be considered. So I just gave the example of your college. In your college, the sports department and library department, usually there is no revenue. But the management decides how much cost we can allocate for the library department this year to purchase new books and developing the infrastructure related to that and all. There will not be revenue. Then the librarian, the head for the library, will be responsible for the cost spent and other things for that particular center. This is called cost center, smallest segment. Revenue center is usually a sales department. So sales department head is responsible for generating good sales. Compared to the previous year, he has to ensure the sales should be increased. Can be defined as a distinctly identifiable department, division or unit of a firm that generates revenue through sale of goods or services. No control over cost and sales price, but sales staff will get more sales from all kinds of customers. Their intention is to see in the showroom, no, the salesman and girl will be selling. They don't have the rights to change the price and they don't think about the cost. Their only intention is increase the sales revenue. Last year they sold for 1 lakh. This year they have to sell for 1,10,000. Like, is that okay? This is called revenue center. Profit center is nothing but where cost and revenue both are involving. Some business unit have control over both cost and revenue. It's a combination of these two. And in this case, cost should be minimized and revenue should be increased. So both will be taken care in case of profit center. Finally, investment center. So investment center is all about capital budgeting. Like, okay, huge investment for capital. Okay, means assets. Responsible for both revenue and expenses, but also for related investment of capital. Highest level of responsibility center, usually the investment center will be held by top financial officers, right? Lower level management will not be assigned this job, right? Deals with investment for every division and ROI will be the main criteria of investment center. So we have 4 investment centers, responsibility centers here. And information for responsibility report. So you have to report it. While reporting, you have to report in the form of monetary and non-monetary. Okay, non-monetary. So you have to report. as you are being the head for the responsible center, you have to give the report to the management whether you are doing it properly or not, right? So for that, while giving the report, you have to consider two aspects. One is monetary, another one is non-monetary. Monetary is all about you are aware about the price you spend, like budget and actual revenue, budget and actual cost, revenue related, cost related, and variance computations for revenue as well as cost both, and investments. So all these four aspects. Okay, four centers are there. No, all the four centers predominant in the case of monetary will be reported first. Non-monetary, capacity, number of defects, backlogs, and actual market share, and target rate of output, and customers complaints handled, and production interruptions, safety violations, whether are we able to reduce these things compared to the previous year or not, will be considered as a non-monetary. So information for responsible reports. So while reporting, you have to report monetary as well as non-monetary both to the management to prove your department is performing good or not. And responsibility accounting helps organization unit managers to conduct 5 basic control functions. So every unit manager should conduct 5 basic control functions. Number one, preparing a plan and communicate output expected and delegate authority. Preparing a plan, first he has to say what I plan to do for this department and communicate this to the authority. Gathering actual data classified in accordance with the activities and categories, monitoring the differences between the plan and actual. Fourth, taking the remedial actions if there is any difference from the planned actions, and continuing comparing the data and responding to them now and then. So these are the 5 steps: plan and communicate, and gather the actual performance. So plan, actual, and next one is comparison between plan and actual, and if there is any deviation, remedial steps, and repeat the same 4 again and again. This is what about the continuation. Clear? 5 basic control functions. Now, what are the predominant assumptions we have? The areas of responsibility are defined for which managers should be held responsible. So, defined and managers are held responsible. This is the predominant assumption. Managers are only charged with the items and responsibility over which they can exercise. If I am not able to control, then how can I be responsible? So, managers are charged only the items they are responsible or they are able to control. If they could not control, direct control is not possible, then they are not made responsible for that. And managers should also actively participate while budgeting, planning, and goal setting. Only without his consent, how can we make the decision? So we call for all the divisional managers, asking them what could be the work done by them and what could be the target they can get achieved. Based on that discussion, the targets and goals are finally. So while deciding the goals and targets, the management divisions managers also be participated, and goals are defined for each area of responsibility, and should be attainable with efficient and effective performances. Okay, with efficient and effective performances. Okay, efficient and effective performances. Clear? And efficient is the term used for doing the work in lesser time. Effectiveness is the doing the same work without any error or matching with the desired output. So output is the main criteria. Here consumption of input is reduced. If you are able to finish the exams, okay, 3 hours exams in 2.5 hours, then you are efficient. Is that okay? Effectiveness, you finished in 2.5 hours, but you completed only 50 marks question. You left another 50 marks, means ineffective. So effective means all the 3 hours question is completed, that too completed in 2.5 hours. The time consumption, input hours is reduced or input quantity reduced, then you are efficient. The output is as per my desired level we achieved, then it's called effectiveness. Okay. So the goals defined along with these two terms also. Control. Reports should contain significant information. So while he sends the report, once it is over, then report is prepared and all the significant information should be there. and responsible center managers should try to accomplish the budgets. That's all very simple. So he tries to achieve the goals we set. Now, what are the advantages we have? The advantages is nothing but facilitates the delegation of decision making, right? So we created 4 or 5 divisions and we make 4 or 5 managers as the division head, and we now delegate the work to the division managers, and you get the managers getting promotion and other things to reach the goals, and they also get trained, and guide to evaluation of performance of these managers, and the standard can be also verified, and permits effective use of concept of management by exception. Management by exception, so already told you, effective use of the concept of management by exception. So you can use the management by exceptions concept to decide whether the managers are doing or not. So we have two management principle. One is management by objectives, another one is management by exception. So this is all about management by exceptions, which helps us to decide whether the division performing better or not. Preparation of responsibility report. Now, how the report is prepared? The responsibility accounting performance report is a budget that compares actual and budget. Okay, and this will be prepared as statement. That too, only controllable costs are going to be listed, actual and budget. What we plan, what actually happened. If there is any deviation, is it controllable or not? If it is uncontrollable, it's not coming in the report. If it is controllable, then why didn't you control? Why did you allow the amount to be spent more than we expected? And you have to give this reasons also. Clear? That's all about responsibility accounting. Two questions are there for understanding these concepts. It's a theory like, discussion like. The processing department of a large company informs marketing department, processing department and marketing department that the price of processing 2 lakhs items will be 50 lakhs. So 50 lakhs is for 2 lakhs unit. That's a budget process department told to the marketing department. The marketing department submits the material for the item 2 weeks later than originally planned. Immediately, marketing department submits requisite material, but delayed while supplying. Delay is happening, and tells the processing department that the scheduled date of completing has been advanced 2 weeks. So, two things happened here. Number one being, what's that? Number one, the requirement for manufacturing is supplied 2 weeks later, and demanding to supply this 2 weeks earlier. The requisite raw material supplied by the marketing department to the processing department 2 weeks delayed, and demanding the cutoff date is 2 weeks earlier. Almost 4 weeks has been crashed. Within shortage of 1 month you have to finish off. 4 weeks means equivalent to 1 month you have to finish off. In order to achieve the new schedule, the processing department incurs additional production cost rupees 16 lakhs. Because of this one, what happened? You understood now already. If you are supposed to reduce the time consumption, you have to spend more money for overtime and all. That leads to increase in the production cost from 50 lakhs to 66 lakhs. Like in an organization using responsibility accounting, where would the additional cost be assigned? Now the question is, what is the treatment for this cost? Can I consider this 16 lakhs as a part of production cost? Or production cost being only 50 lakhs, this 16 lakhs is only due to marketing department's urgency. So as we are studying the responsibility center, production department has, or processing department has no role with this non-controllable. But this is due to whose urgency? Marketing department's urgency. Now this cost is assigned to the cost of marketing department. Making the marketing department responsible for this cost and ensure the next time this should not happen. If this 16 lakhs is added to the production department, assume the sale price is 70 lakhs, then naturally what happens? Production department says 60 lakhs, 66 lakhs, and sales prices for 70 lakhs means 4 lakhs is profit. Okay, marketing department demands around 10% revenue for that. So probably this is processing department, and for marketing department they will get around 7 lakhs commission. As per the responsibility center as responsibility accounting, 15 lakhs will go where production processing department cost. Another 16 lakhs is now added to marketing department cost. And for marketing department, 7 lakhs is their commission, 63 lakhs is the net sale revenue. From 63, 50 is subtracted, 30 lakhs is the profit for the process department. Here, 9 lakhs is the loss for the marketing department. If the marketing department says that I brought sales of rupees 60 lakhs, sir, okay, give me incentive. Immediately now management will take the action. You brought okay, but you delayed. Because of that reason, we are penalized like so, will not give the commission. Now, who is responsible for this 16 lakhs is the matter here. As per the responsibility accounting, this 16 lakhs is made responsible in the hands of marketing department, not the process department. Would these costs be considered as controllable cost? What effect might this have on future printing orders from the marketing department? This is controllable cost, but it is assigned to the marketing department. If it is being the assigned cost for the marketing department, we are now making them responsible for that, so they will be double cautious. Only because of supplying the material 2 weeks later, demanding to get it delivered 2 weeks earlier will be a trouble. So marketing department will be cautious in the next time. In an organization that does not use responsibility accounting, where would be the various cost be assigned? If we don't have the responsibility accounting, this is the model. If we use the responsibility accounting, this is the model. Clear? Hope you'll be now able to understand this one. Question number 2. Consider each of the following scenarios. Mr. P.K. Dhawan, plant manager for the laser printer factory of Bharat company, brushed his hair back and side. Here the term is very interesting. Brushed his hair and side and says very tired. December had been a bad month. 2 machines had broken down and some direct laborers all on salary. Were idled for part of the month. Because of the breaking down of the broke down machine breakdown, employees are idle, but salary is payable. The salary payable during the idle time is always lost. So this is what about the loss to the management. Materials prices increased and insurance premiums on the factory also increased. No way out of it. Costs were going up. He hoped that the marketing VP, vice president, would be able to push through some price increases, but that really was not this department. Okay, so 2 departments are there. One is plant manager, another one is marketing. Now, for each of the above independent scenarios, indicate the type of responsive center allowed, whether is it being cost or revenue or profit or investment center. So this one, plant manager always cares about only cost. So this will be, cost, then this will be what? Cost center. Revenue pushing is not their own responsibility, it is a marketing department's responsibility. Now, Mr. P.K. Dhawan should be very cautious. Next time, the breakdown should not happen. He has to do maintenance properly and periodical check to reduce the breakdown. If he is able to check this, then idle time can be reduced. Because of reduction of the idle time, simply they can save this idle time cost payable to the laborers. Moreover, as they are finishing this manufacturing ahead of the price hike, material price increase also be saved. Okay, current material price being 100 rupees, sometimes later it may be 105. You finish up today itself at a cost of rupees 100, it will be quite bit okay. Hope you will be now able to understand this. Mrs. Sonam Kapoor was delighted to see that her ROI figures had increased. For the 3rd straight year, in the last 3 years, the ROI figures increased. She was sure that her campaign to lower cost and use machinery more efficiently, enabling at factories to sell several older machines. Okay, what happens, she manufactured with the lower cost by controlling, and older machines remains unutilized, sold, and money realized. So investment is also reduced, revenue is cost also reduced. By reducing the investment, ROI will be increasing, right? So if your profit being 10 rupees for every 100 rupees, it is 10%. And if you are able to reduce the investment from 100 to 50 rupees, then your ROI is 20%. How this is attained? She has sold some old unused machines. So by selling this, capital investment is now released, remains unutilized, right? So for 100 earlier 10 rupees, because of old machines kept idly in the factories, generating no revenue, is removed. Because of that, revenue is not reduced, but your investment is now reduced. That's how she did. Was the reason why she planned to take full credit for the improvements of her semi-annual performance. She says that because of this reason, so I will take the full credit, sir. Okay. The numerator is the revenue, and this is attainable due to the cost also, right? So then we have what? Revenue as well as cost. Then it will fall under profit center. Profit center. Only revenue. Marketing department is only revenue center, and production department is usually only cost center. When you have control over these two, then it is called profit center. Large investment, then investment center. Clear? Hope now you'll be able to understand this concept. With that, responsible accounting chapter is completely over. Now we'll move on to the next one. Decision making. Decision making under certainty, risk, uncertainty. Okay. See, how do you decide? In case of certainty condition, you will have no problem, you can make the decision. Risk, what you expect may get deviated. What you expect is definitely achievable, then it is called certainty condition. What you expect may deviate, then it is called risk situation. Okay. Now, when it is all about uncertainty, what we expect will not be attainable. So my expectation being 10, what about the actual thing happened? 10 units sale. You expected 10, but you sold only 7 or 12, then it is called risk. This is negative risk, this is positive risk. Anyhow, risk happens. I expected 10, but actual being either it may be 7 or 12. So this will be called as risk and uncertainty. When it is all about risk, okay, this will be controllable. This will be classified as controllable. This will be considered as non-controllable. Why? This is planned using the probability and all, but this will not be such a way. Clear? So what could be the expected number of units to be sold in the coming years? Clear? So you may expect it may be around 1 lakh units, 1,20,000 units, or 80,000 units, like it may have 3 range. Based on the probability, you can guess what could be the expected one. You can closer to actual can be guessed. Is that okay? In controllable scenario. Non-controllable, whatever the things you estimated due to the COVID, now what happens? There's a lockdown. Sudden lockdown. Due to the economic recession, okay, there is a war or conflict between nations, like in US and India now, huge tariff, unexpected. How can you act for that? Then it is coming under non-controllable events. This is called uncertainty. So in case of risk, you can use what? Probability to minimize the risk. Okay. And in case of uncertainty, you don't have any options to escape from that. You have to bear this. In case of certainty, guarantee, no problem, you can go investing. So if you invest in the treasury bond, what you invest, what you expect to get, you will be getting. In the case of stock market, it is a probability. Uncertainty, then it's totally based on the uncontrollable situations. You have to understand the difference between risk and uncertainty. Risk, probability of winning or losing is called risk, right? Uncertainty, a situation of unknown future event like COVID, and suddenly what happens? Indian government reform the GST now. Drastically, GST rates decreased. Because of that, the sale increased for the automobiles suddenly. So the car price decreased by around 1 lakh or 1.5 lakhs also because of this reason, GST. Here it's a negative, it's a positive. In case of US tariff on Indian import from India, 50% as well as another 100% on pharma. These two are negatively affecting the market, and this is positively affecting, but it is not certain, unknown. But here you can guess, okay, what could be the units of sale in the coming Diwali season or January New Year season. All can guess using the probability. Here it is not so. Ascertainable, yes, risk can be measurable, but it is not measurable. Outcome, chances of outcomes are known. We have either, in case of betting, winning and losing is there, right? So winning and losing is there. So you can now find that there is chances. Cancelling the event, very rare. Due to some reason, the event itself cancelling, then the outcome is unknown. And controllable, yes, this one is controllable, this is not controllable. Minimization, possible in case of risk. Here you cannot minimize the risk. And probabilities, here you can assign, here you cannot assign the probability. Hope you will be now able to understand the difference between risk and risk and uncertainty. Now come on, tell me. You can answer this very easily. You can answer this very easily. Make it faster. Guess the answer. Tell me. Payoff matrix. State of nature. In the coming day, may be sunny or rainy. Sunny or rainy. Okay. What happens today? The day may be sunny, weather may be sunny or rainy. Choose a course of action in the following certain cases. If the day is certain to be rainy, what will you do? In sunny day, selling ice cream will fetch you 1,000 rupees. In case of rainy day, rainy day, ice cream sales will be only 500. In case of coffee, sunny day, you will get only 600. In rainy day, you will get around 800 rupees. If you are pretty sure that coming day being rainy, you chosen this, in that the highest possible is this one. Means you have to sell the coffee. If you are sure today is rainy, you will go with raincoat or umbrella. Understand? Clear? In case if the day is certain to be a sunny day, confirm it is a sunny day. In sunny day, what is the highest possible? 1,000. This 1,000 is because of selling ice cream. Clear? In case of certainty, you don't have any tension. Okay. What happens if you join BCom? Degree is guaranteed. If you join CA, then the risk comes here. Is that okay? Clear? You will now be able to understand. In case of risk, then what you have to do? You have to plan. Okay. Second option also, what happens in case of worst scenario. So with that, what is over? Certainty is over. Next, we'll go for the risk scenario. How do you decide in case of risky scenario? And 8.3 is the uncertainty scenario. 8.4 is the decision tree analysis. With that, all the topic is over here. Now, in case of decision making under risk, what will you do? You have to apply the probability. Very simple. Expected value. So, how do you calculate the expected value? Choose the course of action. I'm not sure coming day being sunny or rainy. I'm not sure. I'm not sure. Is that okay? but the probability of occurrence of sunny day being 0.85. Probability of occurrence being the rainy day being 0.15. This is probability. You can plan to go for selling tea or ice cream. I will go for tea. Okay. If I go for the tea and the day happens to be sunny, how much is your revenue? 30. If the day happens to be rainy, your revenue is higher. Is that okay? So you plan to go for selling tea. As we expected 85% is sunny, your revenue is only 30 for the 85% probability. Suppose if it is being rainy, your sales is 300 rupees. Your revenue is 300 rupees. But the probability of that is only 15. Then expected value of selling tea being, you multiply these two, 25.5. This will be 45. Your revenue being 70.5. In case of ice cream, if it is being the sunny day, your revenue being 150, and in case of rainy day, your revenue by selling ice cream is very, very lesser. 85% of 150, 127.5, and 15% on 10, 1.5. The overall value being 129. So, in this probability, you have to choose this one. If the probabilities difference are sunny day is 0.4, rainy day is 0.6, then the answer may be different. You can try it yourself. So, you are able to measure what could be the nature, state of nature in the coming day. Based on the state of nature, what could be the probability of choosing either selling tea or ice cream, and between these two, the highest probability or highest revenue generating options you have to choose. Clear? This is what about the risky scenario. Now, next one. Two investments have different returns. Projects A's expected return is 20%. Return on investment for A. And then the standard deviation of its return being 15%. Project B's expected return being 10% and standard deviation being 9%. Which project is relatively riskier? If you want to find out the relatively riskier, you have to find out coefficient of variations. Coefficient of variations. All these things you might have studied in your financial management, especially risk. That same risk comes here. So standard deviation by mean. This is called mean. X bar. And 15 by 20. 0.75. 10 is expected, but the deviation being 9 from there, then 0.9. If the coefficient of variation is higher, then that will be riskier. Okay, so which is riskier? This one is riskier. This is second riskier. Standard deviation itself measures the riskiness only. This itself riskiness only. But it is absolute term. Absolute. And coefficient also measures the riskiness, but it is a relative term. This is similar to scoring 50 marks and scoring 70 marks. Who is performing better? You tempted to say B is performing better. It's called absolute term. But maximum mark being, in this case 100, in this case 200. 50 for 100 means 50%. 70 for 200 means 35%. So here what you have to do? What you have to do? So 50 by 100. No, this is called coefficient of variations. You can Expressed in relative term. Relative term will give different answers and more logical answers rather than the absolute term. So while measuring the riskiness, the investment or return may be equal means you can go for the standard deviation. Else it's preferable to go for the coefficient of variations. Is that clear? Now let's move on to the next question. Now, question number 3. Pioneer Project Limited is considering accepting one of the two mutually exclusive projects X and Y. Cash flow and probabilities are estimated as under, and cash outflow for X being 45,000 in case of Y being 54,000. NPV is given. Now what you have to do? You have to find out the expected NPV. How do we calculate the expected NPV? So it's a variation of financial management only, right? How do you get the expected NPV? You have to multiply the probability for the difference NPV and sum that for project X. For project X. 12,000 into 0.1, 1,200, 2,800, 6,400, 3,600, 2,000, then summation being 16,000. Expected NPV. Expected NPV. Or simply summation. In case of project Y, .1 into 8,800, 3,000, 4,800, 5,000, 2,400. Right. 16,000. Surprisingly, both the project gives you same NPV. Is that okay? Both the projects are giving you same NPV. Though both the projects are giving the same NPV, but project Y requires more cash outflow, 54,000. Okay, project X needs only 45,000 rupees and project Y needs 54,000 rupees. By investing 54,000 and getting 16,000 is least chosen item compared to getting 16,000 rupees for investing 45,000. So project X is predominantly recommended here. But in case of absolute NPV case, project X and project Y will give the same NPV. We cannot choose one of these two, right, in absolute sense. Apart from that, we have to calculate what? Standard deviation of the project. How can you calculate the standard deviation in this case? You recollect the topic from the FM, not here. In financial management, I guided you separately for the CMA inter only related to the risk. The same concept will be applicable here. Now, for the standard deviation, formula. Okay, NPV minus NPV bar. Okay. Now, to the power 2 and multiply with the probability. Take the summation of all this value and take the root finally. Clear? So we have to find out this one. This will be assumed to be NPV bar like mean. This may be X, this is X bar. Rather than Xi, instead of using X and X bar, I use X represents NPV, X bar represents mean NPV. Okay, mean NPV, average. Average in this case is nothing but multiplying the probability with the various NPVs we have. Yes, come on. First one, you calculate here. First, probability of X minus X bar to the power 2. Come on, finish up this. 12,000 is the X, 16,000 is the X bar. So for the first one, 12,000 minus 12,000, 16,000 to the power 2. Don't forget to multiply with the probability 0.1. What's the value? 16 lakhs. Repeat the same for remaining for 4 options. 14,000 minus 16,000, 2,000 to the power 2 into probability 0.2, 8 lakhs. 16, 16, 0. Again 16, 16, 18, 16, 2,000, then 8 lakhs. And 20, 16, 4,000 difference is there. Like the first one, so 16 lakhs will be the answer. Then the overall value being 48 lakhs. What I supposed to calculate? Standard deviation. Standard deviation being root of this. So we calculated this one, summation of this one. Root of this being 2191. 2191. Okay. Now you have to find out the coefficient of variations also. In case of coefficient of variations, standard deviation divided by X bar. 16,000 is the X bar and standard deviation being 2191. From the expected NPV, 2191 deviates. Is that right? 2191. Are you getting? So 2191 divided by 16,000, this value be okay, 13.69. 13.69 percentage. Similarly, for the project Y, probability into X minus X bar to the power 2. First we'll calculate. For the first one, X being 8,000, X bar being 16,000 to the power 2 and probability for the first case being 0.1. Here the value being 64 lakhs. Again 40 lakhs. 0, 40 lakhs. 64 lakhs. Summation being 208 lakhs. Take the root of this 4,561. Covariance, coefficient of variation in this case being 4,561 divided by 16,000. The value being 28.51. Which is a riskier? In absolute sense also, project Y is riskier. In relative sense also, project Y is riskier. So better you can choose which one. Project X can be chosen. Clear? Text me. Now, next one. Building Limited owns land in Noida and intends to build a condominium development on the site. The company is deciding on whether to build a small, medium, or large development. It has determined profit payoff will be. So the profit payoff is given. Clear? So you can build what? Small, medium, or large size condominium, and demand may also be low, medium, high. If you build small size condominium and demand is whatever it may be, low, medium, or high, your return is 1400. Okay, clear? Now, if the demand is, if you are constructing the medium size building, condominium is otherwise the building, like you build for 100 capacity, but the low demand is only 800. Remaining 100 capacity, but the demand is only 80. 20 capacity rooms or building size remains unutilized, may be lost. Because of that reason, your revenue is decreasing. If the demand is also same, then you are happy. If the demand is higher, you cannot support for them. You might have studied the similar one in your operations management also. Okay, especially simulation model. So where we have the random numbers and all. If the demand is so much, how many materials you can purchase and hold. Similarly here also. If the demand, you constructed the large condominium, but demand is low, you are losing. Medium and your return is 1200. High, then you can enjoy the maximum profit here. And probability of that situation, the demand situation may be low, medium, and high given here. Given here. Now, so I jumped to some sums, right? Okay, let me finish up the fourth sum now. Sorry. The following information is available for a company: sales volume and applicable probability given. Projected sales and cost are given. So sales per unit 6, variable cost 3.5, and fixed cost also there. Required probability that company will at least break even. Okay, find out the break even point. What is the break even point? Break even point is equal to in terms of units, fixed cost divided by contribution, otherwise sales minus variable cost per unit. Fixed cost 34,000, sales 6, variable cost 3.5. Then what's the value you are getting? 13,600 units. Now the question is probability that the company will at least break even. At what point in time we are able to break even? Okay. If the sales demand is only 10,000, we cannot break even. If the sales demand is 12,000, we cannot break even. In these two scenarios, we cannot break even. In case of 14,000, we can break even, break even, break even. Now, what is the probability that we sell around 14,000 units? 25%. The probability of selling 16,000 is 30. Probability of selling 18 is 20. The probability of selling beyond 13,600 being the summation of the three. What's the value? 25 plus 30 plus 20, 75%. Our probability to reach break-even point is 75%. Next one is probability that the profit will be at least 10,000. In case of desired profit case, fixed cost plus desired profit divided by sales minus variable cost. Fixed cost 34,000. Your desired profit being 10,000. And sales minus variable cost 6 minus 3.4. Come on, get me the final value. 17,600. So what happens from here? You have to sell minimum 17,600 units. This is possible only here. This is possible only here. In all these scenarios, your sales is less than 17,600. Definitely there is no chance of break even. Only here we have the chance of break even. So the probability being 20%. Clear? Which one? 44 divided by 2.6. Check. Okay, this is 3.5. Okay. Okay. Now, next question. Building Limited owns land in Noida, intends to build a condominium development on the site. The company is deciding on whether to build a small, medium, or large development. This is all about calculation of expected value. Then expected value of perfect information. Okay, you know that expected value. How do you calculate the expected value? Applying the probability with the various options. So now C, probability being 0.2, 0.35, 0.45. These are the three natures: low demand, medium demand, and high demand. Okay, if you construct the condominium being a small size, what will be the return? 1400 in all the scenario. You multiply these two, 280, 490, 630. In all the scenario, 1400 means ultimately you will get the 1400 only. This is called expected value. Similarly, calculate for medium. In case of medium, 1100, 1600, 1600. 1100 into 0.2, 220, 560, 720, overall value being 1500. In case of large, 1300, you are facing loss if the demand is low, but you constructed the large condominium. Otherwise, 1200, 2100. Then multiply with the probability, 260 loss, 420 gain, 945 high, gain for high demand, and overall 1105. Now, among the three, what do you plan to choose? You choose only medium, because the expected value from constructing the medium condominium being 1500. So the expected value being 1500. Is that clear? Clear? If you construct small, then your expected revenue is 1400. If you construct large, your revenue is only 1105. Small gives, medium gives you more revenue. Medium gives you more revenue. Now, what more? EVPI, expected value for the perfect information. Come on, tell me. If somebody is willing to give you information regarding what sort of the demand you can predict in the coming day. Now, for that information, how much will you be able to pay money? That's the logic. Okay. Now, expected value for the perfect information. If you are getting the perfect information, what happens? This seems to be certainty decision. In case of certainty decision, if you are aware about that today is only sunny day, you choose the option gives you more revenue in that day. When there is a probability, then you multiply with the probability to reduce the risk. Somebody is now willing to give you the information, what should be the state of nature in the coming day. Now the question is, how much will you be able to pay for that? Okay, that information. If you are informed that coming day low demand will be there, so you choose what? 1400. Right. If you are stated that coming day medium demand will be there, then you will choose this. Or high, then you will choose this. If he says the status of demand in the coming days being low, then you will choose 1400. You will construct medium only, low. In case of medium, probability being 0.35, you choose what? This one, 1600. In the case of high demand in the coming day, the probability of the high demand being 0.45, you choose what? 2100. Now multiply all these three. 280. Make it fast. 9? 945 for third. 560 for second one. What is the total? This is what about the expected value of perfect information. If you are not aware about the status, then you will decide rough calculation based on the probability. If you are aware about the exact state of nature, you can decide this one. So you are willing to pay 285 rupees for the person who gives the information. This is what about the cost of expected value for the perfect information. Clear? ABC company is trying to set the possible sales price for one of its products. Three prices are under consideration. So we plan to have three prices. Okay, and expected sales volume and cost are as follows. In case of best possible, most likely, worst possible, in these three scenarios, the revenue will be different. Expected sales volume in units. If you fix the price being 4, you can sell around 16,000 units in case of best possible. Worst possible, you can sell only 10,000. If you fix 4.4, the price being higher, in best possible scenario, you will sell only 12,500 units. Higher the price, lower the units sold. Is that okay? Now you have to find out the profit for all the scenarios. Fixed cost 20,000 and variable cost of sales being 2 per unit. Now tell me, what happens if you fix the sale price being 4? Profit if sales price being 4, 4.3 and 4.4. How do you calculate the profit? Sales minus variable cost, contribution into quantity minus fixed cost. Okay, so here variable cost is 2, so C being 2 rupees, 2.3 rupees, 2.4 rupees. In case of best possible, 16,000 units into 2, 32,000 minus 20,000 rupees. 2 rupees into 16,000 rupees minus 20,000. So your profit being 12,000. In case of 14,000, another 2,000 extra sold means 2,000 into 2, 4,000 rupees will be higher. Lower, 4,000 lower means 8,000. In case of 10,000 means 10,000 into 2, 20 minus 20 is 0. Right. In case of 4.3, 2.3 will be your value. 2.3 into 14,000 minus 20,000 rupees. Come on, tell me. 12,200. 8,750. In case of 8,000, 8,000 into 2.3 minus 20, 1,600 loss. 1,600 loss. In the last scenario, 2.4 is your contribution into 12,500 minus 20,000. Yeah, you'll be getting 10,000 profit. Next, 8,800. Finally, you'll be facing with 5,600 loss. Now, what could be the chosen one? Which price should be chosen? If you think best possible scenario, the highest revenue is possible here. For this, the sale price being 4.3. In the case of most likely, 8,800 is the most highest profit, so you can fix the price being 4.4. And here, in these two scenarios, losing, but here don't earn any profit loss, so you can choose 4 rupees. Now, you have to determine whether the possibility of your sales. Is it best possible or most likely or worst possible? Based on that, you can make the decision of fixing the price. Is that clear? So hope you'll be now able to understand decision making when the events are riskier. When the events are riskier. Now we'll move on to the next one. So first we have started with certainty. Next we continue with the risk. Now we'll be dealing with uncertainty. In case of uncertainty, we have maximin minimax theory, Laplace criterion, Savage criterion or regret, Hurwitz alpha criterion. So we have been given 4 alternatives. Maximin as well as maximin. Maximax available. Let's now try to solve this illustration. Given the following payoff table of profits generated by an entity under different conditions of the future state of nature. Right. Yes. Now, we'll start with Maximax. So we have been given 4 states of natures. As you have been 4 states of nature, you have chosen one of the 3 alternatives. These are the 3 alternatives you have chosen, right? Clear? The name Maximax says the maximum of every alternatives. First you have to select. Among them maximum will be the chosen alternative. That's what about uncertainty. Maximax. Come on, tell me. What is the maximum benefit you are getting in alternative A? What about maximum in case of alternative A2? What about the maximum in alternative 3? Among them, what is the maximum one? So A1 is chosen. A1 is chosen. Is that clear? Very simple. This one is chosen. And maximin. So we'll be dealing with maximin. Come on, tell me. Maximum of what? Minimum. You have to choose the minimum in all the alternatives. In A alternatives, -1, A2, 0, A3, 0. Among the 3, minimum being this one. So you have to choose A1. Okay. Sorry, maximum. This is minimum. In that minimum, maximum is chosen. Maximum being these 2 are maximum. So you can choose one of these 2 as you wish. Options are there. Select one of these 2. If you want to choose 2, you can choose both the thing. A2, A3. Maximin. Sometimes it may be minimax, minimin. 4 aspects are there. Minimum of minimum. and minimum of maximum and all 4. Maxi max, maxi min, mini max, mini min, 4 aspects. Of course, all these things are, we are not using that anyhow, it's still kept in the syllabus, we'll be dealing with. Okay. Next. We'll move on to the minimax regret or savage criterion. Okay. In case of savage criterion, what is this one? Mini max regret, or this is otherwise named as savage criterion. Now, what is the term regret mean here? What does it mean? Regret. Feeling sad of not getting. See, you have been given two options, 100 and 1001, 1005. Mobile, two mobiles are there. Otherwise, 1000, 10,000 and 10,050 as a gift. What's your favorite color? Your favorite color? Blue. Probably this one is blue, this one is dark red. Now you are getting this one and another mobile is given to your brother. Will you feel sad? No, sir. Sir, your brother gets 50 rupees more than your worth. So what? Doesn't matter. I like blue color. Clear? Now, another one is 10,000 rupees, blue color. Another one is 1 lakh, red color. As you choose always blue color, now you are given blue color. You choose always blue, no? Your brother will get red color. This is iPhone, this is other local phone. Now tell me, as your wish, blue color is given. Tell me, will you be happy? Here, the difference between these two, 50 rupees, because of choosing this one, not choosing this one, causes a loss of 50, a meager money, you will not regret for that. Because of choosing this one, you are not choosing this one. You are not allowed to choose this one, but the loss is almost 90,000 rupees. The regret will be higher here. Hope you will be now able to understand. So, regret is the difference between two numbers. If the number is higher, if you are not given the higher value item, you will be regretting more. Clear? So, that is what about regret case. A regret case. First of all, you have to calculate the regret table here. Regret table. Regret table S1, S2, S3, S4. What is that? You have to array the regret table. Tell me. In regret table, okay. In this column, S1 column, find out the two maximum, 3 and 6. 3 and 6, okay. Now, what is the maximum? 6. From the 6, 3 is subtracted. What's the value you are getting? 3. 6 minus 6, 0. 6 minus 0, 6. Is that okay? Take the highest value. From that highest value, subtract the other item in that column. It means regret. You have chosen this one, not chosen this one. Then what about the feelings of this? 3 rupees, sir. Not you are given this one, your friend is given this much. 6 rupees. Definitely you will have the regret of 6 rupees because of not giving, not offered the A to you, A3 to you. In this case, all are 5, then naturally no regret. What do you want? Anything, sir, no problem. What do you want? Anything, no problem. But here 8, you choose that one only. If you are given 8, you don't regret. If you are given 2, your regret will be 6. If you are given 6, your regret will be 2. In the fourth case, highest being 4, here minus 5, otherwise 5, your regret being 5. Here 4, here 0. If you are given A3, you will be very happy. Instead of A3, if any other things are given, you will be feeling sad and regret. Okay. Okay. In this, minimum of maximum will be calculated. Your regret should be minimum. Find out the maximum first of all. What is the maximum of this A1 alternative? 5, 6, 6. This is regret only, no. Your regret should be reduced, right? So to reduce your regret, you have to go for minimum of the maximum. Mini-max regret. Minimum of this being this one, so you have to choose A1. A1 is chosen. Clear? Shall I move on to the next one? So we have completed maxi, max, mini, maxi, min, minimum regret. Sorry, mini-max regret. Mini-max regret is otherwise named as Savage criterion. Savage criterion. Now we'll go for equal regret. Equal regret C is a D, and Hurwitz alpha criterion. Next one being Hurwitz alpha criterion. Yes. In this case, equal regret case, you have to give the value here. What's that? Every state of nature will be given equal value, weightage. Okay, weight is assigned. Weight is assigned. Is that clear? Now, find out the expected value. Summation of probability into x. This will be considered as probability. Weightage is considered as probability. This is x. Then expected value is going to be calculated. That's called equal regret. 3 into 0.25, 5 into 0.25, 8 into 0.25, and minus 1 into 0.25. Yes, tell me. I think you will be getting 3.75. 3 into 0.25, 5 into 0.25, 8 into 0.25, minus 1 into 0.25. Sum all. Hmm? 3.75. The same way for E2, 3.25, 3.75. So, in case of equal regret, you have to find out the maximum expected value. That will be chosen. Maximum expected value is 3.75, 3.75. So, you can choose these two. A1, A3 can be chosen. A1 and A3 will be chosen. Equal regret. Otherwise named as Laplace criterion. This will be otherwise named as Laplace. Okay. Laplace criterion. Now we'll move on to the Furvik's alpha. In case of Furvik's alpha, how do we calculate the expected value under Furvik's alpha? D is equal to A into maximum of any alternatives plus 1 minus alpha into minimum of alternatives given. Okay. In this, highest will be chosen. Let's see. Alpha value is given here 0.1, 0.4. Alpha 0.4, maximum of alternative 1 being 8 plus 1 minus 0.4, minimum of alternative 1 minus 1. What is the final value? 2 point. Cross check. This is 0.4 into 8, 3.2, 0.6 into minus 1, 0.6, then 2.6 will be the answer. This is 1 minus alpha, 0.6 into minus 1. Okay. The next scenario, same way, 0.4 into maximum of this one being 6 plus 1 minus minimum of this one 0, 0.4 minus 1 minus 0, sorry, minimum 0, right. The ultimate value being 2.4. The last one being 0.4 into the maximum being 6 plus 1 minus 0.4 into it's not minus, okay, multiplication of minus 1. Oh, that's how you get confused, right? It's a multiplication of minus 1, sorry. Okay, here multiplication of 0, then it is also 2.4. Row maximum will be the chosen one. Row maximum 2.6, this will be chosen. So A1 is chosen. In majority of the options, A1 is chosen, so we can recommend go for A1 here. Go for A1 here. Now let's move on to the next one. Cost matrix. See, here we have seen the profit matrix, so our profit should be higher. In case of cost matrix, you have to reduce everything. Think in a reverse manner. Think in reverse manner. So here it's all about mini-max. Mini-max. Okay. Julian Point School is preparing summer camp in the jungles of Bogora, district of Darjeeling, in train individuals in wilderness survival. JPS estimates that attendance can fall into one of four categories. Okay, maybe 200, 250, 300. So one of the four categories may be possible. The cost of the camp will be smallest when its size meets the demand exactly. I constructed 250 capacity, demand is also 250, then our loss is lesser. If we constructed for 200, the sales is 350, I am losing the revenue. If I construct 350, I get only 200 admissions, then 150 will be loss. Spare capacity will be loss. Deviation above or below the idle demand levels incur additional cost resulting from the construction more capacity than needed, or losing income opportunities when the demand is not met. We have the demand, but we have not met. Letting A1 to A4 represent the size of the camp: 200, 250, 300 and 350. This is the size of the camp: 200, 250, 300 and 350. These are the alternatives we have. And S1 and S2, S1 to S4, the level of attendance, the following table summarizes the cost matrix. Now, we'll start with what? Mini-max. First, to find out the maximum of every row, and in that minimum will be taken. So here, what about the maximum? Row maximum, 25. One more thing. Yeah, 25, 23, 21, 30. Row max. In that minimum, min max, minimum of maximum. What is that? So you have to choose A3. You have to choose A3. Is that clear? Next one is all about savage criterion. Regret. So in case of regret, you have to prepare a regret matrix. Regret matrix. How do you calculate the regret matrix? Okay. Now, in case of profit matrix, how do you calculate? Regret. Maximum value is taken, from that we subtracted. In case of cost, just to reverse, from the minimum you have to subtract and all. 5 minus 5, 0. And here, this one is all about S1, S1, S2, S3, S4. Regret table. And here 3, 16 and 25. You have to be double cautious. In case of cost matrix, from the lower number you have to subtract. In case of profit matrix, from the higher number you have to subtract. Similarly for S2, lower number being 7. So 10 minus 7, 0. 7 minus 7, 0. 18 minus 7, 11. 22 minus 7, 15. Similarly here, the lower number being 12. So 18 minus 12, 6, 0, 0, tie. Here 19 minus 12, 7. And S4, the lower being 15. So 25 minus 15, 10. Then 8, 6 0. Now, in case of Savage matrix, it's a minimum of maximum. First, to find out the row maximum. Row maximum being 10, 8, 16, 25. In that minimum, minimax, minimum being 8. So, what is chosen? A2 is chosen. A2 is chosen. When it is all about Laplace, it's the equal weightage. It's all about equal weightage. Is that okay? Now, I'll go for the Laplace case. So, for all these things, I will give the value A1, A2, A3, A4. What are the options are there? S1, S2, S3, S4. Okay. Now, what's the value here? 5, 8, 21, 30, 10, 7, 18, 22, 18, 12, 12, 19, 25, 23, 21 and 15. Give weightage, equal weightage, 4 numbers, no? 1 by 4, 0.25 is the weightage. Yes, come on. Multiply 5 into 0.25. And you have to add all the 6 after calculations. This will be x. So you multiply these two and sum this. 14.5, 12.5, 18, 21.5. In that, row minimum will be taken. Row minimum being 12.5. This will be chosen. So A2 is chosen. A2 is chosen. Finally, we'll move on to the Hurwitz criterion. In case of Hurwitz criterion, A1, A2, A3, A4. S1, S2, S3, S4. 5, 10, 18, 25, 8, 7, 12, 23, 21, 18, 12, 21, 30, 22, 19 and 15. 19 and 15. You can find out the EV under Hurwitz model. Here you have to find out the D. See, here we calculated the D starting with the maximum, but in this case we have to start with the minimum because the cost matrix now put the value differently. So D is equal to alpha minimum of alternative 1 or alternative whatever it may be plus 1 minus alternative multiplied with the maximum of alternatives given. Now alpha is missing, then you can assume the alpha being A itself, alpha itself. Minimum of this one being 5 plus 1 minus alpha, maximum of alpha being 25. Yes, come on. 25 into 1, 25, 25 alpha negative. Okay. This is 5 alpha. Huh? No. In this illustration, second illustration, not given. In question, this is not given. While answer, I just made the pasting for the earlier illustration so that there's an error. Alpha is missing. So this one is 5 alpha, this one is 25 and minus 25 alpha. Ends with what? 25 plus minus 20 alpha, minus 20 alpha plus 5 alpha minus 25 alpha leads to only 20 alpha. Do the same calculation for the next one. 7 alpha 1 minus alpha into the highest being 23. The final answer being 23 minus 16 alpha. Here lowest being 12, 12 alpha plus 1 minus alpha, highest value being 21. So the value being 21 minus 9 alpha, 9 alpha. The last one, lowest being 15 alpha plus 1 minus alpha, highest value 30. Then final value being 30 minus 15 alpha, 15 alpha. Clear? So with that, uncertainty case is also over. Now, we'll move on to the next topic. It's for additional learning like decision tree. So let's start with the first illustration. Payoff table in decision tree format. LT Limited owns land in Bangalore and intends to build a project development on site. The company is deciding on whether to build a small, medium, or large development. Demand is uncertain and fluctuates. Demand could be low, medium, or high. Management at LT has determined the profit payoffs to be this way. In this case, your alternatives being small, medium, or large, demand being low, medium, and high. Low, medium, and high. How can you plan here? How can you plan here? See, we'll plan this way. We may have small, let me explain this. A decision tree, like it's very simple illustration. So what are the choices we have? We have the small option or medium option or large option. If I construct small, the demand could be low. This is alternative. This is demand option. Demand can be low, medium, or large. But the probability of this being 0.2, 0.35, 0.45. 0.45. If it is being medium, alternative being medium, Again, we may have the demand low with the medium and medium with medium, medium with the large. And the probability being 0.2, 0.35, 0.45. And we'll go for large alternative where low demand, medium demand and large demand may be possible. High demand may be possible. This is high demand. Okay. The probability of this being 0.2, 0.35, 0.45. Now, what is the result? In the first scenario, 1400. In the second scenario, 1100, 1600, 1600. Already we have seen the same illustration, right? Okay, then here 1300 loss, 1200, 1200. Seems to be a tree like, right? That's why it is called decision tree model. Decision tree model. Similar illustration was already solved. Here is clear. Similar number, but we are using what? We are using decision tree model. Hope you'll be now able to understand this. It is all about payoff matrix. Like there, it will be totally different. So if you are asked to prepare under decision tree model, you have to prepare this way. Okay. Now, how can you find out the expected sales? You have to multiply these two. Expected value. 280, 490, 630. The expected value when we have small being the summation of the three, 1400. In case of low case, 0.2 into 1100, 220, and here 560, here 720. Now the expected in this case being 1500. Now what about here? 260 negative and 420 positive, 945 positive. All the three will be summed up and we'll get 1105. Then you can take the average. It is assumed that every alternative will have equal options, equal probability. 1/3, 1/3, 1/3. Okay, in that case, the company's whole payoff can be calculated but not required in this illustration. Okay, so in case of small, your expected value being 1400. In case of medium, your expected value being 1500. In case of large, your expected value being 1105. Clear? Make a note of it. And this second illustration, most probably I don't expect you may get this question in your exam. And I request you to go and watch the videos recorded in the previous class. Okay, go and see that for this one. It's very rare. I don't know why they added here. It may be applicable final, but they have added here. We'll move on to the next question, question number 3. This question number 3 you might have studied in your OM paper. This question number 3 you might have studied in OM paper. Okay. TT News agent stocks a weekly health magazine. The owner buys the magazine for rupees 30 paise, sells them for 50 paise. So if he is able to buy and sell, nicely making a profit of 20 paise per copy, but no sale after buying, then the price paid will be lost. This will be the loss. At the end of the week, unsold magazines are obsolete and have no value. The estimated probability distribution for the weekly demand is shown below. Weekly demand being 20 or 30 or 40. Probability is also given. You are required to calculate the following. What is the expected value of the demand? Expected value is nothing but multiplication of these two. Come on. 4 30 into 0.55 16.5. This one being 10. 30.5 will be your expected demand. Now, if the owner is to order a fixed quantity of magazine per week, how many should that be? So, weekly demand could be 20, 30 or 40, no? So, he may have the chance to buy and hold 20 units, buy and hold. The same 20 or 30 copies or 40 copies. But demand being 20, 30 or 40. An applicable probability for this demand being probability 0.2, 0.55, 0.25. Tell me what happens. You hold 20 units, demand also 20. Definitely all the units purchased sold. If you are selling all the unit, 20 paise will be gained, so 4 rupees is your gain. 30 demand is there, then also you will get only 4 rupees gain. 40, then also you will get only 4 rupees gain. What is the expected value? Expected value is nothing but probability, and this one you have to multiply and take the summation of this 4. Clear? If you buy and hold 30 units, sell 30 units, then per unit 20 paise gain means 30 into 20 paise, 6 rupees your gain. Demand is 40, anyhow you have only 30 units can be saleable, so for 6 rupees is your gain. You buy and hold 30 units, but the demand is only 20. What happens in this case? Okay, in this case, out of 30, only 20 sold, giving a profit of 20 paise each, 4 rupees. Another 10 units remains unusable, non-saleable, that will be your loss. So ultimately you get only 1 rupee gain. 1 rupee your gain. What about the expected value? Expected value is nothing but multiplication of probability and this one. So 0.2 into 1, 0.55 into 6, 0.25 into this one. So the ultimate value being 5. If you buy and hold 40 units, what happens in this case? What happens in this case? 40 units you buy and sell also 40 units, then 20 paise gain means 40 into 28 rupees here. But in this case, you purchased 40 first case, but you sold only 20. But another 20 remains unsold, 0.3 is loss, 6 rupees loss. So ultimately 2 rupees being the loss here. 40 purchased but 30 sold means 30 into 20 paise is your gain, 6 rupees. Another 30 remains unsaleable, for that another 10 remains unsaleable. For that I lose 30 paise per copy, so 3 rupees is my loss, so ultimately 3 rupees is my gain. So what about the expected value? 0.2 into 0.2. So 2 rupees loss into 0.2, 3 into 0.55, 8 into 0.25, the ultimate value here being 3.25. So how many copies you can buy and hold? Expected value is higher for buying and holding 30 units, so it's recommended to buy and hold 30 units. Is that clear? Similar sum you might have studied in OM paper, in especially simulation. Is that topic over? Simulation topic? Random number all may be used, right? So the same topic here without random number we studied. And request the fourth sum to be tried by yourself. Yes, just go and refer the videos. So with that, all the content of management accounting is over. Get prepared for your examination by referring